In these times of gloom and doom, there is a lot of skepticism, pessimism within the investing community about recession, interest rates, inflation, and now valuations. But there happens to be a sector which has emerged as a darling among investors. Now, this particular sector has the largest weightage in our indices and is also known as a proxy for the economy. In fact, it is a key driver for both economic expansion and inclusive growth. In 2022, this sector has outperformed Nifty 50 by a fairly large margin. So what exactly is propelling this rally? And the big question is there any more upside left for this sector? To answer this question, we bring our very own research specialist, Franklyn Moraes, who covers this particular sector to gain deeper insights. Let's begin. You're watching Informed Investor, the Third Empire, an initiator by Research and Ranking. This year, the banking industry has been the favorite of investors. Now, experts and investors alike have increasingly favored stocks from this sector. The Bank Nifty index has given exceptional returns, outperforming not only the benchmark but most other sectors in 2022 so far. The Nifty Bank index has surged 19% in 2022 as against a 5% rise in Nifty. The Nifty PSU Bank Index, which consists of 12 public sector banks, has surged more than 60% since the beginning of 2022, outpacing the broader Nifty Bank Index's rise in the same period. So what exactly is driving this rally? Let's understand. The COVID threat to the global economy has just passed, and the same is true for the Indian economy. But during the COVID times, loan growth was dreadful and was at a multi-year low. As a result, the banking industry struggled in those times. However, during the past several quarters, we have observed that credit growth has begun to accelerate throughout the banking industry. Now, strong credit growth is at a multi-year high and is predicted to stay strong as a result of improving economic activity, a pickup in the capex cycle, and the festive season. The banking and financial sector was also the star performer in terms of earnings reported for the quarter ended September 2022. While we saw manufacturing, FMCG companies' margins decline, banking sector reported strong profitability. Now, the surprise in Q2 also came from the PSU banks that did much better than expectations. Now, the stock price too reacted positively to the excellent results and the positive commentary. Now, strong profitability reported by banks is on the back of robust growth in net interest income, which is the difference between the yield a bank earns on loans and the interest it pays on deposits. Now, private sector banks and public sector banks have made the most of rising interest rates, passing on rate hikes. The rise in profitability is aided by the combination of loan rate hikes and delayed deposit rate increases. Now, when interest rates are growing in the economy in a scenario such as this, net interest margins for banks becomes greater as seen on the chart in your screen. Another key factor for the smooth running of the banking sector is the improving non-performing asset levels. In the last decade, banking system in India, especially public sector banks, was plagued with NPAs. Banks were lending to infrastructure projects, particularly in the electricity, steel and telecom sectors. Now, this was done without proper due diligence because they wanted to show significant loan growth. Now, they failed to do their own feasibility assessments on projects, instead relying on promoters' feasibility reports. Now, furthermore, the situation deteriorated during the 2008 financial crisis. The RBI then permitted banks to restructure debt and not categorize it as a non-performing asset. Now, this was a one-time measure given to banks to help them get through the tough period. However, this was extended and this saddled the system with unrecognized NPAs. Realizing what the problem is, the RBI under Governor Raghuram Rajan made special inspections during 2015. And then introduced asset quality review mechanism where banks were forced to recognize their non-performing assets. Now, once recognized, banks were rightfully made to provide for those bad loans. Now, in short, banks were forced to clean up the bad loan mess so that only those assets were shown that can truly earn income from them. Now, as a result of these measures, we saw the gross net performing asset ratio peaking in fiscal year 18. Now, since then, however, bank asset quality has been steadily improving. The recent rally in the market can be largely attributed to the improving asset quality. Now, importantly for the banking sector, will the asset quality keep improving? Now, this will be answered by a research specialist in this session. Now, the rally among banks was more broad-based, but it was only open to a small number of NBFCs. Now, this is due to the fact that NBFCs do not benefit as directly from an increase in interest rates as banks do. Now, even as interest income is boosted, non-bank lenders have to take a hit on the liability side as they are big borrowers from the market. To understand this better, we will virtually connect with Franklyn Moraes, our research specialist, to gain deeper insights into the current business environment, credit growth, asset quality trends, and outlook for the overall banking sector going forward. Thank you, Franklyn, for virtually connecting with us today. So, Franklyn, my first question is related to the credit growth in the country. Now, we are currently in a rising interest rate regime, and despite high interest rates, we see credit offtake on a double-digit growth curve, almost touching a decade high. But Franklyn, this is of course on the back of the economic recovery post-COVID. But the question is, are we actually seeing a broad-based trend in credit growth? Also, another question, we also see corporate borrowing momentum picking up. But will the current macroeconomic environment pose any threat to the capex-related growth?
Yeah, thanks for that question. So we have seen bank credit growth virtually picking up from the COVID lows of 4.9% to currently at 17%, and this growth has been at a decadal high. While this growth has been quite good, it has also been broad-based, which is very important to note. So if you see the corporate sector had been languishing for a very long period. So the growth was virtually flattish, and now we are seeing a very strong pickup, in the corporate sector. So that is one very important reason. Also, the MSME sector has also started now doing very well. So we are seeing 20% plus growth, in the MSME sector, which is also contributing to growth. Services sector has also been quite good, delivering 20% plus growth, and it's led by the bank lending to the NBFC segment. So that lending has grown very sharply at 30% per annum. So within the retail segment, the retail has been the mainstay actually over the past few years. So retail has been growing at 15-16%. But here also we have seen a bump up. So retail has been able to grow at 20%, and that's led by the unsecured book. So your personal loan segment and your credit card segment has done exceedingly well. So that's the reason. That's the broad-based growth that we are looking at. However, we need to look at certain aspects also. So let's look at it a little bit in more detail. So if you look at if you look at the capex cycle had been muted for a very long period of time throughout the last decade, if I must say. But like last couple of years, we are seeing a bit of pickup in that capex cycle. So that trajectory has started moving up. And also important to note that although the trajectory has started moving up, the capacity utilization is not falling. So the capacity utilization is also rising. So as the capacity utilization, which is presently at 72%, if once it starts crossing 75-76%, you will see more and more corporates coming up and putting up capacities. So that is also very strong indicator from a growth perspective. However, you need to also understand that these capex cycles are over a long period of time. So today, if somebody tries to, if somebody wants to put up a plant, it would take him at least 5 to 7 years on an average for that entire project to get completed. And much of the proceeds or the requirement from the corporate will come towards the latter half. So we may not see that growth coming in immediately in the banking sector in terms of your credit growth, but that definitely will be visible 3 to 5 years down the line. That's why it's very important to set up a plant today and start the capex so that the growth will be seen. And that's why many of the times we would probably see people saying that corporate capex is kind of not picking up or is not very visible in the numbers. But definitely we are seeing green shoots. We are seeing that trajectory improving, and it's definitely a healthy sign. Another reason why we have seen good growth in credit is because of the shift from the debt market to the bank borrowings. So if you see from the pandemic period, the borrowing rates in the debt market had already started picking up. While in the bank lending, it is the repo rates and all have started inching up only in the last 6 months. But for the bond markets, those rates had already started inching up a bit from a longer period of time. That is why there are corporates who have actually shifted on an incremental basis from the debt market to the bank borrowings. And that's why if you realize earlier also NBFC sector, we saw the growth was up by 30%, but on the asset side they grew by only 10%. So on the liability side grew by 30%. It's because they have shifted that mix towards bank borrowings. So as and when things normalize, these rates or the growth rates which we are seeing can kind of moderate a bit. So while maybe 17-18% kind of a number is not sustainable, but I surely feel that 14-15% on a sustainable basis is very much doable.
So frankly, this is something I highlighted in our intro. I mean, rising net interest margin was a huge positive for private and public sector banks. But when we look at for NBFCs, we see mixed trends. So why exactly are net interest margins for bankings expanding, whereas for NBFCs, it's slightly falling?
Yeah, so that trend is very much visible. For that, we need to understand the fixed and floating components. So banks lending is the bank's advances have a very high floating component, which means today if a bank revises its rate, it will immediately show up in their books. So that gets translated into margins for them. But in this case, like MCLR and repo rate linked, the total portion of that in the banking credit is quite high, and that is the reason why banks are able to pass on the benefit of the rising rate immediately on the asset side. And on the liability side, you have your CASA, which is kind of a fixed book. So your deposit rates are not going to increase that quickly. So that is the reason why the higher floating rate is leading to a rise in margins. And we've seen this week also the RBI raised the repo rate by 35 basis points. So this kind of margin improvement which we have seen in banks is likely to continue so long as the rate cycle is prevalent. So this chart also shows you clearly how the margins have kind of increased. So April, May is the period wherein RBI actually started raising rates, and since then the margins have only inched upwards. So this is for the system as a whole. Another important reason to note is the credit deposit ratio. So the credit deposit ratio, the CD ratio, is basically for every 100 rupee of deposits, what is the kind of credit that goes in. So if you see historically, we were at the lower end of the CD ratio, which means we had adequate amount of deposits, but credit growth was not there. So now, as we have going forward, we see the CD ratio picking up. But still there is further scope for the CD ratio to pick up further, which means that without a meaningful increase in deposit growth, we can still grow our credit growth. And that also leads to an expansion in margins because your cost of deposits is not increasing at that pace compared to your cost of credit. So these are some of the reasons why bank NIMs have been expanding. Coming to NBFCs, if you see largely, the NBFC NIMs are either flat or slightly negative, barring a few exceptions. So the reason for this is that NBFC NIMs are largely fixed in nature. So your NBFC assets have a high component of the fixed assets. So while banks had a higher floating component in their assets, NBFCs have a higher fixed component, which means when the rate increases, since the asset is fixed, you cannot increase the rate immediately. You need for the asset to move out of your book, and only on an incremental basis you can pass on the increased benefit to the borrower. So that is the reason why NBFC margins have been taking a hit. So this trend could continue for some more time, wherein bank margins would increase, whereas NBFC margins would kind of be flattish or slightly negative.
So my next question is related to the asset quality of banks. So banks are showing strong improvement in asset quality, and maybe the rally in the banking sector can be largely attributed to this positive development. But Franklyn, how really is this sustainable, and can we see any further improvement in asset quality going forward?
So the problems with asset quality began way back in 2012, wherein RBI gave a restructuring benefit to the banking sector. Post that, in 2015, the problems continued to mount, because of which RBI finally came out with its AQR, and that led to a lot of corporates going into default. So a lot of banks reported NPAs, especially on the corporate front, and those were quite bulky NPAs, which led to significant increase in asset quality. Subsequently, we saw the impact of demonetization, GST implementation, RERA, and finally COVID, which led to subsequent asset quality problems. But important to note is banks had already started focusing on recovery and improvement in their asset quality performance, which is why you see that the COVID impact has been very less, and in fact banks have kind of bounced back very quickly. It's because of this continuous hard work on trying to control asset quality and the NPAs, which is reflecting in the current asset quality numbers. Also, it is important to note that while asset quality has shown improvement, also your coverage has kind of improved. So your provision coverage ratios today for PSU banks is at 72, and for private banks is almost at 80%. And these are also near all-time highs. So while there is whatever stress is there in the system, banks are very well equipped to cover that stress. And also on an incremental basis, the SMA 0, 1 and 2 numbers, which are the ones which have defaulted but have not yet come into NPA. So that pool has also shrunk quite substantially. So it's an indicator that future NPAs are also likely to be lower. So lower future stress along with good coverage on an existing book means that asset quality performance is likely to continue going forward.
So in the last decade, Franklyn, public sector banks were plagued with NPA issues, low credit growth, high credit cost, etc. Now we see things are taking a turn for the good, and this can also be reflected in the stock performance of the PSU banks. But how sustainable is this improvement, and are there any risks that can derail this improvement?
Yeah. So public sector banks are basically a reflection of the corporate cycle. So when corporates do well, public sector banks do well, because that comprises a large portion of their credit. So we see that the corporate cycle has already started to meaningfully improve over the last few years. So wherever there have been problems, corporates have actually sold off their assets and kind of had cleaner balance sheets. There has been asset transfer from weaker corporates to stronger corporates. So that cycle is largely done with. And now going forward, corporates are in a very strong position to kind of kickstart the lending phase again. So when corporates come to the market and start borrowing in a meaningful manner, it will definitely help the public sector entities. So that, I believe, has already begun, and that journey is only set to rise going forward.
So we also see a rise in unsecured book of banks and NBFCs. So what exactly is driving this growth, and can this pose a risk going forward as they don't possess a collateral as such?
So it is very interesting because the unsecured books have actually better GNPS compared to the secured books. So one very important reason is banks do a lot of rigorous understanding of the borrower before which they actually lend to this kind of segment, because they are aware that it's an unsecured product, and banks generally lend it to their existing borrowers. That is also very important factor for this, the quality of this book being very good. Now incrementally what is happening is there is a lot of digital focus which has been given. So banks are implementing a lot of digital means to kind of attract the borrower, push it through aggregators and so on and so forth. So that is one aspect which is kind of leading to that push. The second point is that today our credit rating systems and all are very robust. So in 2008 cycle, when retail was struggling, that time our systems were not as strong. But today we have got good credit rating systems wherein we can assess the credit worthiness of a borrower, and it's widely accepted and very well tested to understand that. So banks can rely on it, and banks can make more meaningful conclusions based on that. So that system has also kind of given it a lot of strength. And thirdly, if you see, because of this digital law, a lot of the banks are trying to improve the convenience for the borrower. So you have pre-approved loans wherein your assessment has already been done. You can just click the button and get the money into your account within a matter of 15 minutes. So this kind of the share of this pre-approved loans is also kind of increasing within the system. So that is also kind of helping you to improve your TAT and push more and more loans. So these are some of the factors because of which this segment is kind of seeing a robust growth.
Absolutely. Okay, I would also like to take a moment to talk about the housing finance sector. Right now, housing finance sectors are exhibiting mixed growth trends between large and affordable ones. So why exactly this divergence?
So the large housing finance sectors are actually competing with the larger banks, and banks became very aggressive when they wanted to focus on security. Housing finance sector as a whole provides a lot more security. So that's why banks started lending in a more aggressive manner towards the housing finance, towards the housing sector. So that's where some bit of pressure came in terms of growth for the larger housing finance companies. Second reason why these struggled is because the large ticket houses there, that's more investor led compared to the smaller ones. So there we've seen some bit of pressure coming in, so some lesser interest from the investor led demand. So that led to some pressure on the large ticket houses. So because of that, also the larger HFCs kind of struggled to deliver on growth. And thirdly is that a lot of them had actually got into non-housing loans, like be it construction finance or a LAP. So these segments also struggled. The non-housing segments also struggled, and because of which again these guys, like be it the likes of LIC housing or PNB housing, so they were focused more internally on trying to adjust their books and stabilize their portfolios. But coming to the smaller ones have got a very good push from the government, from that PMAY schemes. So government had a very strong push on affordable housing, and that's when these smaller banks actually latched onto that benefit, and they have been able to grow because that underlying demand itself was very strong for smaller houses. And smaller banks have also very good capital. So if you see the likes of Aptus or Home First, the capital adequacy is in excess of 50%, which means that they have got ample of ammunition to grow their books in a very aggressive manner. And plus, they never had the problems of lending to a corporate or a construction finance loan or a LAP, which is a very big portion of their book. So they were into pure affordable housing, and that segment has done quite well. So that's why this divergence between the large ones and the smaller ones.
So I think we've covered everything important in our Q&A session, but I do have a big question for you. So right now, Nifty, and this question will actually be largely appreciated by our viewers. So right now Nifty Bank is at record high, I think surging about 20% year to date, and you've got the Nifty PSU Bank surging about 60%, more than 60%. So Franklyn, the big question is, how long will the good times last?
I think the good times have just begun. So, that trend, that challenges that we were seeing for the last 10 years, every time there was some or the other hit which the banking system was taking. So, we are probably at the end of that hit, and the good times have just started because we are seeing a reversal in the fortunes of banks. The lenders, the people to whom the banks borrow, they are in good shape. So everybody, be it corporates, be it mid MSMEs, be it even the retail segment, each and every one of them are in really good shape as of now. And I think this journey is only going to get better as we move forward.
Okay, those are some really good things to know, Franklyn. So anyway, thank you so much, Franklyn, for joining us today and speaking with me about the banking sector and the outlook going forward. And thank you to our viewers for watching this special episode of Third Empire. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.